You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. Now, we mentioned last week that the FANG stocks were going to be breathing heavily this week. We had Google announcing on Monday. Facebook is announcing today after the close as we tape Options Playbook Radio, and then we got Amazon on Thursday. So three of the big FANG stocks are announcing this week. And on last week's show, we looked at a skip strike butterfly in Alphabet, i.e. Google, and that trade was a very simple trade. Google actually decreased in price. We were on the bull side of it. We did it for a net credit of 35 cents. Google was a little bit all over the place, but then eventually settled down quite 30, 40 points. So that trade should have expired worthless. And no worries, simple trade. You just close it out. You make a mere 35 cents for your dealings, and that's just a minimum, almost covers commissions on a 1x2x1 trade. I don't know how many contracts you might have done on your paper trade, but that's what happened with Google. So it was interesting that we were able to set up a trade and be dead wrong on the direction, but we were able to get paid on that trade. So ideally, if the stock would have went up and it would have went up more than expected on the upside, then that trade would have had a potential to be more profitable. Okay, so let's look at, I'm going to talk about just a pure speculation trade on Facebook. Facebook, just in general, has been beat up. Everybody, unless you've been under a rock, everybody has known that they've had some issues with how they're sharing their data with outside vendors. And because of that, Facebook has been beat up recently. Hoping that maybe earnings could make people forget a little bit about what has happened with their data issues. So I'm going to look at a way to just totally speculate on Facebook. And I'm assuming some people out there own some stock. So you could use this in one of two ways. You could look at it as, if the news is bad, I don't mind buying a few shares. That's one way to approach it. And if we do that, the strategy will also work for that. But then, on the upside, I might be down a little bit depending on where I might have bought that underlying stock. So let's try to get some money back just in case Facebook knocks this thing out of the park. All right. So no specific strategy to talk about. This is just a pure flat out speculation bid is on Facebook, and we're going to sell a put spread. So if you have the Options Playbook on your table and you want to just look at what two-legged trade would be, selling a short put spread, and we're going to use that capital to buy some long calls with it. So a very bullish strategy in the least to do. And the short put spread is on page 66 inside the Options Playbook. If you do not have the Options Playbook on your table, don't worry though. You can always go to optionsplaybook.com and click under the strategy tab and you look for short put spreads. Okay, so we'll be short and sweet. Facebook is just about to announce earnings here. Right now, we showed that Facebook on the close, the last trade was 159.69. We're going to be very bullish because I just gave a little bit of a scenario, but as always on Options Playbook Radio, this is never meant to be a recommendation. We're just trying to learn. So I think there's an opportunity to try to speculate, and I'm going to show you if I was going to just purely speculate around an earnings, this is how I would go out and I would attempt to do that. Now, we're going to sell a short put spread, and we're going to hopefully use the capital from that short put spread to go out and pay for a long call option and an out of the money, purely speculative long call option. So we're going to try to make the credit from selling the put spread very close to the cost of the call option. And why am I doing that? No particular reason why, except for the fact that I kind of like the concept of owning some long calls at a reasonable price, basically bringing in a net credit and getting long some calls. Okay, so here's the trade, and then I'll talk about nuances of it. I'm going to go out and I'm going to look to sell a further out put spread to pay for the near-term out-of-the-money call options. And I like going out a little further in time on put spreads because if the market were to tank in Facebook, the time value on a $160 stock is still fairly substantial just going out a week in time. So in our scenario, let's start by looking at what the expected move would be once Facebook announces earnings, and that should be happening here any minute, actually. And I am showing that as far as Facebook is concerned, the near-term at-the-money straddle is trading for, let's call it $8.30. All right, so we'll say it's looking for about an $8 move on this underlying. So with the stock, we're going to round up to 160. On the close, 152 is an $8 move to the downside. Where would I feel comfortable selling a put spread? I'm going to go almost double that. Double that would be 16 points down. I'm going to look at selling the 145 put. And I'm currently showing that if I go out to the May 4th expiration, which is 9 days away, this isn't the nearest term expiration, and I'm chose that expiration because of what I said. I think time values can protect me a little bit in this scenario. I am going to sell the 145 put and then go down 5 points and buy the 140 put. Now, that can be done at the midpoint for a net credit of 35 cents to the account. So, once again, I am selling the May 4th expiration, 9 days away, 145 put in Facebook, and then I'm protecting myself by buying the 140 put with the same expiration. The 145 is trading for around 60 cents. The 140 is trading for around 30 cents. Bottom line is, well, actually the midpoint it's showing me is a net credit of 35 cents. To the account. So in this scenario, I got 5 points of risk. The maximum upside that I can make is 35 cents. So you take 5 minus the 35-cent credit received. Your max risk is truly $4.65. We are almost double the expected move in this underlying to a downside. So Facebook has to really tank after it's already tanked. Anything's plausible in this market, though. We always want to make sure of that. And then since I brought in a 35-cent credit, I'm actually going to go and look at a near-term call option just because I'm going to blow that 35 cents. Hopefully I can, I'm going to buy a lottery ticket with it. And if Facebook does rock and roll after this earnings announcement, I'm going to be positioned to make some money if it makes more than the expected move. So we went 15 points on the downside to sell a put spread. We're going to go to the nearest term expiration, and we're going to go about 15 points up. And I'm basically just looking for something that I can buy for around 35 cents because I'm assuming that I could get somewhere close to a midpoint fill. Now, once again, not meant to be a recommendation. I'm just showing how I would purely speculate on an earnings report. And I just don't like buying out of the money puts. I'd rather, or out of the money calls in this scenario. If I'm bullish, I want to try to find a way to get them paid for. So I see here that the 135 call with the nearest expiration, April 27th, so it would be this Friday's expiration, is trading for 30 cents. So if I did this entire trade, now that's on the asking price. If I did this entire trade, I sold the May 4th expiration put spread that we just mentioned, and then took that money and went and bought on the ask the 175 calls that expire on the 27th, this Friday. I can get that entire trade done for a net credit of 5 cents to the account. All right. So if I'm wrong and Facebook goes down and it only goes down the expected move, well, obviously my calls are going to expire worthless, and hopefully my put spread still expires worthless. That's part of the reason why I'm doing this trade. Now, I got a big buffer. Even if it goes down 10 or 12 points, I'm still pretty safe on this bet because I'm 15 points away from where the current stock is at. Now, the odds of making anything on this trade besides that 5 cents are very low because there's a very low probability that Facebook is going to move 15 points to the downside or 15 points to the upside, according to the way the options are priced. We currently have Facebook trading at about 75% implied volatility, but it's very possible just in general in this marketplace to have double the expected move. That's more possible than it ever has been with the volatility recently that we've had in the marketplace. So I don't know what you think. I'll give you my email at the end. Send me an email, and we're going to find out here very shortly if Facebook has outperformed their earnings. We'll know right away on the open if this was a decent trade or if it wasn't a decent trade. And I will give you one last recap of the entire trade from beginning to end. So we are bullish on Facebook, mainly because we think it's been beat up just because of the news. If they blow away their earnings, hopefully they'll get a little bit more of a bounce back and people will have short-term memories and not quite beat up Facebook anymore for the fact that they had some privacy issues with their data. So we are going to sell to open the May 4th expiration 145 put, and then buy to open the same expiration 140 put. And at the same time, we're going to buy the nearest term expiration, the April 27th expiration, 175 call. We would enter this all as one trade and hopefully get it executed for a net credit of around 5 cents to the account. We hope that Facebook skyrockets and goes up 15 points or more on the upside. If the market just stays tame, well, we have very little risk. Our overall risk of this entire trade is going to be 5 points, which is the width of the put spread, minus that net credit received of 5 cents, or $4.95 on this trade. All right, so that's a pure speculation. You would do it as many times as you could afford. You've got to put up the margin for the put spread. Now, another way to look at this is that if you've been long Facebook and you maybe you bought it on the high water mark, and you want to try to, I don't want the cheese anymore, just let me out of the trap. Maybe you can do this just a few times. If you're willing to buy Facebook down around the 145 level, instead of doing a 10 lot or a 15 lot of pure speculation, you can maybe sell that put spread with the intent of actually buying Facebook if it gets beaten up that bad. So I can sell the 145 put there, or if I want to, I could even go up to the 150 put and I'd still do a 5 point wide spread. I just don't want to be flat out naked any of the FANG stocks, like naked a short put or naked a short call going into earnings. That's just not a place where I want to live. So if you're willing to buy it at a lower price, you can actually bring in more of a credit, and hence you can maybe buy a better call option on the upside. But it's an interesting way to say, I will sell a put spread more than willing to buy Facebook another 100, 200, or maybe 500 shares because I want to double up the catch up anyways. So I'm going to take the credit received from that, and I'm going to go out and buy some call options, near term option contracts. And hopefully, if Facebook does explode, not only will I make money from my current stock that is there, but I might make some money on the long shot, near term, out of the money call options. Shoo, so that was a lot. So there's two different ways to look at this speculated trade, just as a pure spec trade, but maybe if you have a long Facebook stock position, maybe this is a way that you go in and you approach the trade to try to just, get your money back or double up to catch up. Now, I did mention, and I don't want to forget, that I was going to talk about why I'm doing the May short put and buying the April, the shortest term expiration long call. And the reason why is purely cost. On the long call, if I'm buying an out of the money call, either it's going to get to that strike or it's not. And if I go out to the May out of the money call, the 170 strike, I almost double my cost. And if it doesn't get to the 170, both of those calls are just basically going to be worthless because of the volatility crunch. So why double up the cost to go out one more week in time when I still need the same move no matter which option contract I buy? So now as far as the put spread, yeah, I like to have that extra week. So let's say the stock does come tumbling down and it gets down to the 145 level where I have an obligation to buy the stock. Well, with a week remaining and Facebook at 145 after a 15-point move to the downside, implied volatility is going to be my friend here. It's going to protect me a little bit, and it's going to offer me an opportunity to just close out the trade, roll the trade. I could do something with the trade. So I like on the short put spread giving myself a week. I bring in a little bit more credit to pay for my speculative out of the money call that I'm going to do in the short term here. And I'm trying to use the expiration and the concept of how options and price and how they expire and how implied volatility fluctuates to put together an interesting trade in Facebook before they announce earnings. So tomorrow morning, we're going to know about this trade. We're going to see where the market opens up at. You do have a few days on the out of the money call. I kind of like the fact that Facebook is announcing on Wednesday. So we got all day Thursday, all day Friday for that market to start moving. So let's hope that happens. And that's it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer on the program, you can send them directly to me at theoptionsguy@invest.ally.com, at theoptionsguy@invest.ally.com. Thanks for listening. We'll be back at the same time and same place next week. Until then, may all the options you bought finish into money and all the ones you sold finish out.
The Options Playbook was brought to you by Trade King Group. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to tradeking.com/ODD to review additional risks involved with trading options. Securities offered through Trade King LLC, member FINRA and SIPC. The Options Playbook was brought to you by Trade King Group. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to tradeking.com/ODD to review additional risks involved with trading options. Securities offered through Trade King LLC, member FINRA and SIPC.